Hey guys, Max here, and this is your daily market update for yesterday, the 2nd of June. Now, how was it for the most part? How were the markets? How did equities perform? Well, as you can see, they actually had quite a strong day. It was green for the most part. Tech in particular did really quite well, big tech especially. You can see Amazon and Google up 3% each. Tesla was up by 4%. Facebook's very green. Really quite a strong day for the big tech companies. The only parts that didn't really do too well were healthcare, which was a little bit red, as you can see here. And then oil companies were pretty much just parring some earlier gains. They didn't really move up or down for the most part, as oil prices have remained quite high. The S&P 500 then rose by about 1.8% by the end of the day. The Nasdaq had risen by about 2.8%, with tech overperforming, as you can see from this map. The Dow Jones Industrial did a little bit poorer, but still rose by 1.3%. And then the Russell 2000, the companies that make up the economy of the United States, did pretty well itself, rising by 2.3% as well. Across the rest of the world, how were stocks then? Well, again, they were actually quite strong. Now, the UK's markets were closed for the Platinum Jubilee, the Queen's 70th anniversary of her reign. So actually, this here isn't accurate, but the rest of this is all quite strong. The Stoxx 600 rose by about 0.6%, and then the MSCI World Index, which tracks every single publicly listed stock in the world, or all the major ones at least, rose by about 2.7%. So really quite a strong day for equities. Now, we saw the dollar's strength wane a little bit more, with the spot index falling by about 0.7%. The euro against the dollar rose by about 0.9%. The pound rose by about 0.7%. So those are now sitting at $1.08 and $1.26 each. We're seeing a lot of to and fro in here. Either the dollar is this safe haven asset, and then the next day it isn't, or vice versa. It's all a little bit complicated, but really, we haven't seen any major foreign currency, foreign exchange shifts over recent weeks. Now, as for fixed income assets, the bond market, the US 10-year Treasury yield rose very slightly, about 3 basis points, and it now sits at 2.91%. The German 10-year yield rose about 5 basis points and now sits at 1.24%. Let's not forget that just a couple of months ago, German 10-year yields were fairly negative. They were in the negative region, minus 0.2% or somewhere like that. And so actually 1.2% is quite a far departure from what has been normality for a long time. Now, unfortunately for pretty much everyone, unless you work at an oil or gas company, energy prices have remained very high. WTI crude oil is still sitting at $117 a barrel. Brent crude is still sitting at $118 a barrel. And this is really due to the EU's most recent sanctions package against Russia, which has just been pushed through the EU Parliament, meaning that, yes, the supply of oil is about to get a little bit worse. Gold also saw some pretty decent inflows yesterday, rising by about 1.3% for the day in price. Right now, gold is sitting at about $1,870 an ounce, getting close to that $1,900 mark once more. Now, for the crypto market, it was all quite a mixed bag. Bitcoin rose a bit, about 1.3%, and is back above that $30,000 mark. Ethereum, on the other hand, the silver horse of the crypto market, well, it fell by the same amount, 1.3%, and it's now sitting at almost exactly $1,800. Altcoins, for the most part, were mixed as well. There wasn't really any one specific trend here regarding the crypto market. Coins were moving in their own directions based on their own individual pieces of news, their own individual inflows and outflows, and that's a good thing for the crypto market. It would be nice if it didn't just correlate perfectly with other risk-on assets. Now, why were stocks up for the day? Why were risk-on assets up for the day? For the most part, of course, not everything was. Well, it comes down to a few different things. The first thing is that investors are expecting some weaker labor demand from the US non-farm payroll report coming on Friday. And if they get that weaker report, if demand for employment is lowering, then that's a good sign that inflation is lowering as well. We also saw Fed Chair Brainard come out and say that actually a 50 basis point hike is likely for June and July, another 2 months. But she specifically didn't say anything past that, meaning that maybe she's thinking back down to 25 basis point hikes by September. That would actually be quite a dovish thing for the Fed to do with inflation this high. I know it sounds weird to say that, yes, continuing to raise interest rates can be dovish, but when you're raising them by such small amounts, when inflation is knocking on the door of 10%, yeah, actually that is rather dovish. Now, we have also heard from the OPEC plus countries, which is basically just a cartel of oil producing countries who collude with each other to limit the supply of oil that they put out in order to maintain high prices and ensure that each country makes a healthy profit. Well, they were already planning on increasing their oil supply because prices are high, so they can afford to do that. But they've just decided to increase that hike by 50% further, which is going to be slightly nice for oil prices. That should help depress prices slightly. It's going to take a little bit of time for it to come through and actually have an impact on markets, but that is good news nonetheless. Now, those are the facts about what is moving markets right now. In my opinion, though, and this isn't fact, this is just my opinion, as I said, this is all sort of based on hopium, the hope that oil prices will fall as things change, the hope that inflation will fall because there's this idea going around that it has absolutely peaked, and the hope that quantitative tightening isn't as damaging as a lot of people fear. Now, personally, I think that is irrational. To be honest, the monetary environment hasn't really changed. We haven't actually got this new inflation data suggesting that it is depressed. We haven't actually seen all that much change over recent weeks. The only thing that we have seen change is the state of the American and other Western economies, and that's not for the better. So no, I don't think these are rational moves. I don't think that this rally is going to remain for long, maybe a week or two at the absolute longest, but I still think we're on a distinct downward trajectory. Now, interestingly enough, we saw Larry Fink come out of the woodwork and talk to the world yesterday. And if you don't know who he is, well, he runs BlackRock, the company that owns the world, supposedly. And he came out and basically said that actually he doesn't think inflation has peaked, or he doesn't think it's going to fall drastically from this point. And that's basically because supply side shocks are still everywhere. This supply chain crisis is still very much the case. If you take a look at a website that tracks worldwide shipping, for example, you'll see that a few months ago, when all the ships were piled up outside ports in eye view of the people in those cities, well, everyone was panicking about those ships piling up. And so the solution to that wasn't to actually fix the supply chain crisis and get those ships sorted. It was just to make them anchor offshore 20 miles away where you can't see them. We see the exact same sort of thing with the chip maker crisis in car manufacturing. It's still there. It's just not really making the news anymore because it's such a mundane topic and we've heard about it so many times before. The supply side crisis is not solving itself. It's not going to solve itself until we see demand destruction, in my opinion. And that basically means that elevated inflation is here to stay. And that's Larry Fink's viewpoint on this issue. He also came out and actually spoke against ESG a little bit, as you can see here. He said that asset managers shouldn't be the world's environmental police. And this is a hot topic for a number of reasons. The first reason is because of this turmoil between Elon Musk and S&P regarding Tesla's ESG score, which has raised a lot of eyebrows, and a lot of people are wondering, how can Tesla possibly be worse for the environment than oil companies, even if it's not perfect? And then we also have this greenwashing scandal by DWS, by Deutsche Bank, that we covered in a video yesterday. If you haven't seen that, then go watch it, go check it out. It explains everything about this greenwashing scandal. But basically, this massive $1 trillion asset manager was lying about how environmental their investors were. And so quite simply, Larry Fink is making it clear that he doesn't agree with DWS and Deutsche Bank. He thinks that actually there should probably be some kind of central authority that determines ESG scores, if there are to be ESG scores at all. And that's a fair point. It certainly shouldn't be in the hand of asset managers. Now, it was actually quite an interesting interview. I would recommend checking it out. I may make a longer form video on this over the next couple of days. Let me know if you'd like that. I also have a long form video coming out surrounding BlackRock itself, the so-called company which owns the world, which controls the world. Hint, it doesn't really control the world. It's a custodian for millions of investors. They rarely vote on company boards and on policies and things like that. But yeah, that video is coming out shortly and it should be quite interesting. Now, next in corporate news, we have some trouble for Coinbase, which is really not doing too well. Now, as you can see here, Coinbase has announced that they're going to be extending their hiring freeze. They're not going to be hiring new people. And a really big thing, a really controversial thing, they're going to start revoking already accepted offers. Now, these are people who work for another company. They're really good at their job. So they've gone out and they found a new job at Coinbase. They've quit their old job. And now Coinbase is going to turn around before they've even started and say, no, we're not having you. Now, that is a really bad sign, not only for Coinbase, but for the economy as a whole. For a company of this size to make that sort of decision, they know they're going to get a myriad of bad press from this. And so their situation has to be really serious for them to take such drastic measures. Sadly, this is the kind of thing that actually we're seeing an awful lot of. Better.com a couple of months ago saw a similar thing where they fired over 1,000 employees, and they did it over a Zoom call because they just couldn't afford to keep running them anymore. Fast, which was a payments processor, had hired 500 people to Fast, wasn't making any revenue, so it had to fire an awful lot of them. What we're seeing here is the tech industry, particularly in Silicon Valley, really panic about their wasteful ways over recent years, and they're realizing finally that money isn't infinite. It will run out, and they can't afford to be so wasteful. Now, this is bad news, not only for Coinbase, as I just said, but for the entire tech industry and the economy as a whole. It's representative of a wider shift in the changing monetary environment. And this is the kind of reason that I think actually quantitative tightening is really bad for the economy. It's going to change the fundamentals of how companies operate, and it's going to seriously stunt our growth as an economy. Now, finally, for corporate news, we're going to finish off talking just a little bit about Apple and their union fight. Now, this article here is actually a couple of weeks old, but it just encapsulates the Apple union problem in general. There is a huge movement amongst multiple very large companies right now to get low-level employees unionized. The big two are with Apple retail employers, the so-called Apple geniuses, the guys who stand around the stores, and then Amazon warehouse workers as well. We're not talking about the coders, the tech guys, the engineers who are making $300,000, $400,000, $500,000 a year. We're talking about the lower level employees here. Now, Apple has been improving quality of life and the working conditions for these employees to try and stop them from unionizing en masse. They have already come out and increased pay and benefits for these staff by actually quite a significant amount. And then the most recent news piece for this, they've just improved their scheduling system to make it more flexible for staff, to allow them more paid time off, to allow them to move around shifts a little bit easier, basically just trying to improve their quality of life to stop them from unionizing. Now, this is another really big shift that we're seeing amongst huge corporate companies in general, this move towards unionization. And in my opinion, it comes from the rise in social media. Now, I'm not the target for these unionization videos. I'm a hardline capitalist, as I'm probably sure you can guess from the type of videos I make. I do believe that unions have a right to exist, but I will certainly be never joining one. I'll never be in a position where I even think about joining one. And yet I'm still inundated with adverts and what really is propaganda. I don't mean that in the negative way. It's just, it's a video or a piece of media that's designed to try and convince someone to change their opinion. It's propaganda. And so the simple fact that this is out there to this extent from these huge companies shows a shift in opinion in my mind. There are going to be loads and loads of union fights coming up recently. Starbucks is another company plagued with this stuff. Walmart is another company plagued with this stuff. It is going to be a huge downpress on these companies' margins, on their razor-thin margins for some of them. Wages are going to be going up. This could contribute to a wage price spiral. It could contribute to a further lack of labor demand. And this is going to cause problems for the economy, in my opinion. Now, just to clarify, I'm not saying that to try and pin blame of a struggling economy on unionized workers. That's not what I mean at all. I'm just saying that it's adding fuel to the fire, and that actually, if you're invested in these companies, this needs to be something that you consider when you try and gauge how much your investments are worth. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts to all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource if the market's falling every week. There's also a link in the description to Untitled Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buying opportunity, then now is the perfect time to join Untitled Capital. Thank you all for watching. Stay stoic. Until next time.